Welcome to Thoughts on the Market. I'm Mike Wilson, Morgan Stanley CIO and Chief U.S. Equity Strategist. Today on the podcast, I'll be discussing the weak finish to 2024 and what it means for 2025. It's Monday, January 6th at 11:30 a.m. in New York. So let's get after it. While 2024 was another solid year for U.S. equity markets, December was not. The weak finish to the year is likely attributable to several factors. First, from September to the end of November, equity markets had one of their better 3-month runs that also capped historically strong 1- and 2-year advances. This rally was due to a combination of events, including a reversal of recession fears this summer, an aggressive 50 basis point start to a new Fed cutting cycle, and an election that resulted in both a Republican sweep and an unchallenged outcome that led to covering of hedges into early December. This also lines up with my view in October that the S&P 500 could run to 6,100 on a decisive election outcome. Second, long-term interest rates have backed up considerably since the summer when recession fears peaked. Importantly, this 100 basis point backup in the 10-year U.S. Treasury yield occurred as the Fed cut interest rates by 100 basis points. In my view, the bond market may be calling into question the Fed's decision to cut rates so aggressively in the context of stabilizing employment data. The fact that the term premium has risen by 77 basis points from the September lows is also significant and may be a byproduct of this dynamic and uncertainty around fiscal sustainability. As we suggested 2 months ago, if the change in the term premium was to materially exceed 50 basis points, the equity market could start to take notice and hurt valuations. Indeed, equity multiples peaked in early to mid-December, around the time when the term premium crossed this threshold. Finally, the rise in rates and the Trump election win has ushered in a stronger dollar, which is now reaching a level that could also weigh on equities with significant international exposure. More specifically, the U.S. dollar is quickly approaching the 10% year-over-year rate of change threshold that has historically pressured S&P 500 earnings growth and guidance. All these factors have combined to weigh on market breadth, something that still looks like a warning. The divergence between the S&P 500 index as a ratio of its 200-day moving average and the percent of stocks trading above their 200-day moving average has rarely been wider. This divergence can close in two ways. Either breadth improves or the S&P 500 trades closer to its own 200-day moving average, which is about 10% below current prices. The first scenario likely relies on a combination of lower rates, a weaker dollar, clarity on tariff policy, and stronger earnings revisions. In the absence of those developments, we think 2025 could be a year of two halves, with the first half being more challenged before the more market-friendly policy changes can have their desired effects. It's also worth pointing out that this gap between index pricing and breadth has been more persistent in recent years, something that we attribute to the generous liquidity provisions provided by Treasury and the Fed. It's also been aided by interventions from other central banks. While not a perfect measure, we do find that the year-over-year change in global money supply in U.S. dollars is a good way to monitor key inflection points, and that measure has recently rolled over again. The recent moves in rates in U.S. dollars is just another reason to stick with quality equities. Our quality bias is rooted in the notion that we remain in a later cycle environment, which is typical of a backdrop that is consistent with outperformance of this cohort and the fact that the relative earnings revisions for this high-quality factor are inflecting higher. As long as these dynamics persist, we think it also makes sense to stay selective within cyclicals and focus on areas of the market that are showing clear relative strength in earnings revisions. These groups include software, financials, and media and entertainment. Thanks for listening. If you enjoy the podcast, leave us a review wherever you listen and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.